Good morning. Welcome to Stock Market Today. It's Tuesday, June 9th, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. Those hit your inbox every trading day before the market opens. So U.S. equities closed higher, quiet Monday trading. NASDAQ closed at a new record high, while the S&P 500 actually turned positive on the year. Energy led the charge, followed by REITs and utilities at the sector level. Treasuries were stronger with the curve flattening. Dollar was weaker on the major crosses. Gold was up about 1.5%. Oil was lower. WTI crude down about 3.5%. All sectors were higher, but as I said, energy, utes, REITs led. So we get to the desk this morning. Futures are down about 1% after Asian equities were mostly higher overnight in a move that was led by Australia and Hong Kong. Japan did decline. European equities are under pressure here this morning. Treasuries are stronger with the curve bull flattening. Dollar is extending its recent weakness against the yen. That's risk sensitive, by the way, and is now stronger against the euro and sterling here this morning. Gold is up 0.5%. Crude oil is down another 2%. So let's take a look at the structure of the S&P here. We opened near the low and closed near the high. I mean, that's about as bullish a day as you can get in terms of candlestick methodologies. 3,000 to 3,100 is initial support, 2,850 to 2,950 below that. I do think the February highs are in play. Do I think we're getting there in a straight line? No, we're overbought in the near term. I think we've got a little bit of a too far, too fast here in the near term. What I actually would love to see happen is a pullback that holds 3,000. Ideally 3,100, but 3,000, right? Establish it as a strong support point and then rally into the highs. That to me would be the ideal situation. This is starting to get a little bit of a parabolic feel to it. And I wouldn't be surprised to see a near-term pullback given the overbought nature, right? Money flow, nice break of trend here, right? If I drew this line, you actually have a break of the downtrend. So that's kind of interesting. But I think as long as these support levels that I'm highlighting here hold on any kind of pullback, the structure of the uptrend remains intact and the highs remain in play. Should these key levels give way, then, you have to start to think about what downside looks like and what a different trend looks like, right? So that's the if-then scenario. That's the conversation you should be having with yourself. That, to me, is what you should be looking at, thinking about as you strategize around what's the market likely to do, and then if this, then that, and then what's outperforming. Right now, the path of least resistance is still higher from a trend perspective, right? We can pull back and still be in an uptrend. What's outperforming within that trend, right? Start to go through your work. Let's hit our market in a minute now. S&P turns positive on the year as Qs trade to new highs. We talked about that. I'm wondering, again, we talked about this as well, too far, too fast. Time for a pause in the rally. I think the case can be made. Cyclical strength speaks to an improving global growth outlook. Now, here's what's interesting, right? We saw some similar cyclical strength in the fourth quarter of last year as the U.S.-China phase one trade deal was coming to completion, and then that completely rolled over. So the market seemed to be discounting some sort of improving global growth outlook, right? Maybe better, maybe just less bad, doesn't matter. So the key here is to just pay attention to the data points along the way. Now, I've been trying in my notes to highlight what are the key data points that tell you that this is playing out, right? My Friday note where I look at copper to gold ratio. You should be looking at currencies, in particular, the dollar against the commodity currencies like the Aussie dollar, Canadian dollar, New Zealand dollar, right? These are going to be your data points along the way. Rates can be a data point. Do they continue to back up as they have been here in the near term, right? I touch on dollar weakness in my note today as a confirming data point, and futures, as I said, do point to a lower open here today. Hitting the power bar perspective now, Dow up 1.7%, 5 to 2 bulls to bears. S&P 500 improves 1.16 on the day, 122 to 27 bulls to bears there. NASDAQ was a laggard again yesterday. Right? Similar theme that's been playing out over the past few days. 36-3 though, bulls to bears. Small caps, IWM, another outperforming day for small caps. 1.9%, 819 to 149 bulls to bears there. Now, what's interesting is bonds upticked on the day. The VIX was actually solid yesterday as well. REITs and utilities were part of the outperforming group after energy. So some interesting dynamics at play that lead me to believe that a pause in the near term could potentially make sense. According to the Power Bar, small cap stocks and large cap stocks are bullish. Major markets are mixed. Speaking of playing for a potential pullback, let's find some bearish names that are overdone to the upside, at least by my work. And I think Brinks is one of them. I'm highlighting in my note today. BCO, bearish rating, weak trends, still below this declining long-term trend line as we are massively overbought with massively bearish money flow. Bearish stock underperforming, overbought with bearish money flow, trading in a downtrend still. To me, if you own it, if you played the bounce, good for you. Might not be a bad spot to take some money off the table. If you do play to the bearish side of the equation, if you run a two-sided book, you run long short, BCO kind of looks interesting to me as a bearish idea. I like bearish ideas in a risk-defined way, i.e. puts and put spreads. So take a look at something like BCO as a bearish idea, if that is in fact what is on your watch list, given the overbought natures of the market currently. Taking a look at our sector tracker now, the movement of the major sectors over the last 5 days, your cyclical rotation still very much at the top of the list. Energy, financials, industrials, and materials, top 4 groups. Middle of the road, REITs, discretionary tech and UTs, comms, staples, and healthcare, your more kind of defensive areas as well, towards the bottom of the list. All sectors higher over the last 5 days. My note today, we really show the deterioration in the relative strength of healthcare that I actually started calling out 2 or 3 weeks ago after it was one of my favorite areas of the market, right? We don't remain dogmatic. When the facts change, you change your mind. Healthcare went from being strong leadership to stalling to breaking down. And if you've noticed, I've hardly talked about it anymore after saying it's breaking down. So relative basis, there could be better opportunities, especially if this rotation has legs. Go back to my work, go back and read my notes. I highlight all of the key data points that I think are important to monitor for the rotation trade, right? So if you're starting to put some money towards the rotation trade, right, and you're trying to assess the odds of it continuing, those are the data points I think you should be paying attention to. Our industry in focus now, innovative tech services. Past 6 months been a monster outperformer as technology has been the place to be. Outperforming the S&P 500 by 21.25%. Power bar ratio still very strong, 31-7 bulls to bears, currently ranked number 13 of 21. Down 6 slots over the past week. So some of the names there that look interesting or warrant more work. YY, very bullish. SINA, SINA, very bullish. Digital Turbine, APPS, APPS, very bullish rating. And check out this chart, right? This is basically what the NASDAQ looks like, right? Bullish, strong trend, trading at new highs, right? Where's the leadership? Here it is, right? Could it potentially be changing? Of course it could be changing, right? That's the rotation we're talking about. But depending on your time frame, this is still leadership, right? Rounding out of an overbought condition, bullish money flow. Obviously, these 31 names here could serve as a good starting point for looking for ideas, right? If those key support levels hold in the market, right? Now you see it all coming together, right? The ebb and flow, the top down, right? We're still overbought here. All the strongest sectors of the market are overbought. All the strongest industry groups appear to be overbought at this point, right? So we want to get some sort of pullback or consolidation that produces oversold conditions that then set the stage for a move higher. Taking a look at what's trending now. The junky stocks are on the move again yesterday. Norwegian Cruise Line, Carnival, right? The opening trades. And I just want to address this, right? We're legitimately seeing bankrupt companies, right? Companies that have filed for bankruptcy or companies that are on the verge of filing for bankruptcy. Take a look at Chesapeake. Chesapeake was up 180% yesterday. They filed for bankruptcy last night. Stock's down, right? if, it speaks to, number one, markets are not totally efficient. Number two, there's a gambling mentality in the market right now that I think process-driven investors will be able to take advantage of at some point. Also speaks to the Fed liquidity that's in the marketplace currently and how it's hard to fight that, right? Because when names like Hertz that have legitimately already filed for bankruptcy are rallying 100%, JC Penney, take a look, go down the list. I call them the gambler stocks or the junkie stocks. There'll be an opportunity there. Oxy, right? Oxy is a little bit more legitimate to me. There's actually an activist investor involved, Carl Icahn, right? But, Hertz, not my game, right? I understand why people want to play there, but, I'm not in the market for excitement. I'm in the market to compound over time. I get it. The casinos are closed. They're just reopening. So we have a lot of gamblers playing the game right now. To me, I think that's going to set up an opportunity. Really not a lot of company specific move driving trading on either side of the board here. So I just wanted to kind of touch on some of the gambler mentality that I'm seeing in the market right now. When people feel like it's easy and they can't lose, that becomes interesting to me. So start paying attention there. So the cyclical rotation continues, and here's what that looks like on a relative rotation graph, right? You can see, look at what's improving: energy, materials, industrials, financials on the verge, right? They are improving, and that's coming at the expense of former leaders starting to weaken, right? Healthcare, tech a little bit on a relative basis, okay? Comms and discretionary are still strong in the near term, still leadership, but here is that rotation. You can see it, right? So you start to see it, you start to throw money behind it when it's here, right? When it's getting into the improving quadrant, as we've been talking about. Remember, 3 weeks ago, I started talking about materials, right? You start to put a little money behind it, some solid names or the ETFs themselves, and then you watch the data points and manage your risk, right? Nobody knows for sure if the rotation is going to last. That's where risk management comes in, right? But if it does, right, your process for identifying ideas will get you in, your risk management will get you out, right? Without having to predict, without having to label yourself a bull or a bear. So cyclical rotation continues. It's kind of interesting to me. We hit on the data points along the way. All right, so the US dollar is one of the data points that I think makes sense to pay attention to, because if you go back, now I didn't go back that far on this chart, but if you go back, right, the global market started to slow. The global economy started to slow in 2018. And that's when you saw copper to gold start rolling over. It's also when you saw the dollar start to rally, with the UUP rallying from about 23 all the way up to about 29 in March. And now we've pulled back here and consolidated. I think that if the cyclical rotation is going to continue, it would likely be accompanied by dollar weakness. One of the data points I'm looking at, right? Be accompanied by dollar weakness. So to me, if 26 gives way, that cyclical rotation likely has some legs. All right, so I'm continuing to monitor the dollar. What we can see here, though, in the near term is that it's oversold and holding above this $26 level, right? So how do we react on near-term rallies, right? How does it play out? I think it's important to pay attention to these other data points from an intermarket perspective. And finally, if the cyclical rotation is real, there's the potential for this one to get really weak, right? This is tech relative to the S&P 500, top, unconfirmed by momentum, breaking the 50-day moving average, still room to the 200-day. I think that if the cyclical rotation is real, that money has to come from somewhere. It looks like it's coming from healthcare in the near term. Could technology be less, right? I think that if this is the start of a new uptrend in the market, right? There's some who argue that March was the low. We could see new leadership, so pay attention out there. It's going to wrap us up for today. I'll be back with you tomorrow.